Investing intelligently and effectively does not require complicated formulas or predictions about the future of the market. The principles that guide financial success are surprisingly simple: patience, consistency, low costs, and diversification. Understanding and applying these fundamentals allows any investor, whether novice or experienced, to build wealth over the long term and minimize unnecessary risks. In this context, passive investing through index funds emerges as one of the most solid and accessible strategies to achieve these goals. An index fund is a financial instrument that replicates the performance of a market index, such as the S&P 500, composed of the largest companies in a country, or the NASDAQ 100, focused on technology companies. Unlike actively managed funds, which attempt to outperform the market through analysis and selection of specific stocks, index funds do not try to predict trends or anticipate market movements. Their passive management allows costs to be significantly lower, which over the long term translates into higher net returns for the investor. Keeping costs low is essential, as even small additional expenses can significantly reduce accumulated returns over time. For example, a 2% annual increase in fees can reduce cumulative returns over a 30-year horizon by up to 40%. Consistency and patience are fundamental pillars of this strategy. The stock market may experience volatility in short periods, but historically it has generated positive returns over the long term. Investors must remain calm during temporary fluctuations and focus on a long-term investment horizon, allowing compound interest to act exponentially on the invested capital. The longer an investment is left to grow without being withdrawn, the greater the benefit of compounding, making long-term investing in index funds particularly effective and reliable. Another essential aspect is diversification. An index fund already includes a wide variety of assets, from stocks in different sectors to bonds and other financial instruments. This immediate diversification helps reduce volatility and risk without compromising potential returns. Exposure to different sectors and asset types decreases the likelihood of significant losses resulting from the decline of a single asset or sector. Additionally, diversification allows investors to maintain a stable and consistent strategy, increasing the chances of achieving positive results over time. Active management, by comparison, has proven to be less effective over the long term. Actively managed funds attempt to outperform the market through stock selection and constant analysis, but most fail to surpass their benchmark index after fees and costs. This is due to the combination of market unpredictability and the expenses associated with professional management. Although some funds may perform exceptionally well in a given year, maintaining that advantage consistently over decades is extremely difficult. Therefore, index funds present an efficient and reliable alternative, allowing investors to achieve solid returns without relying on predictions or special skills to select winning stocks. In addition to passive management, investor psychology plays a crucial role in financial success. Emotions such as fear and greed can lead to impulsive decisions, such as selling during downturns or buying at market peaks, which reduces potential returns. Maintaining discipline, adhering to a pre-established investment plan, and not being swayed by emotions allows investors to maximize the benefits of a passive strategy. Financial education and understanding how markets work are key tools for strengthening this discipline and making informed decisions. The relationship between risk and return is also a central principle to consider. Investing involves taking risks, and higher returns are generally associated with higher exposure to risk. However, through investing in index funds, investors can take calculated risks in a controlled manner, avoiding the need to select individual assets and reducing the likelihood of costly mistakes. Diversification within index funds allows risk and return to be balanced, ensuring that investors can grow their capital consistently and sustainably. Choosing an appropriate index fund involves considering several key factors. Fees should be low, as they directly impact net returns. The fund's exposure should be broad, covering various sectors and asset types to ensure diversification. It is also advisable to pay attention to the fund's consistency, avoiding those with high asset turnover or complex strategies that unnecessarily increase costs. Maintaining a simple strategy focused on the long term maximizes the likelihood of success and allows the investment to grow steadily. The combination of patience, low costs, and diversification is reinforced by the use of compound interest. This principle states that the returns generated by an investment, if reinvested, produce new returns, creating an exponential effect on the initial capital. The key is to keep the investment intact for long periods, allowing the market to work in the investor's favor and accelerating growth over time. Results are not immediate, but consistency and discipline generate significant benefits over decades. Investing with common sense also involves recognizing the importance of taking measured risks and not avoiding investing for fear of temporary losses. Keeping money uninvested, whether under a mattress or in low-load instruments, exposes capital to the erosion of inflation, reducing its purchasing power over time. In contrast, investing intelligently with a passive and diversified strategy protects capital against inflation and allows for returns that surpass this negative effect, ensuring sustained growth of wealth. A well-planned asset allocation is essential for facing future uncertainty. By distributing capital among different types of assets, investors can mitigate risks and adapt to various market scenarios. This strategy allows them to remain calm during market downturns and take advantage of increases during periods of economic expansion, ensuring the portfolio remains balanced and efficient. The combination of intelligent allocation, diversification, and a long-term focus forms the foundation of a solid and resilient investment. In practice, many experts recommend allocating the majority of capital, approximately 95%, to index funds, while a smaller percentage, around 5%, can be directed to riskier investments, considered play money. This separation helps maintain focus on the principal investment while exploring opportunities with controlled and limited risk. The simple, low-cost, and diversified approach not only maximizes potential returns, but also makes portfolio management easier and reduces investment complexity. By focusing on fundamental principles and avoiding attempts to predict the market, investors can maintain their strategy consistently, reduce stress associated with volatility, and build solid wealth over the long term. Intelligent investing does not require complicated decisions or sophisticated strategies, but rather discipline, basic knowledge, and a commitment to the long term. The stock market, although volatile in the short term, has historically provided positive long-term returns. For this reason, investing should be understood as a long game, where decisions are made with perspective and patience without reacting impulsively to temporary changes. Maintaining a stable strategy and allowing capital to grow steadily is essential to harness the potential of the markets and benefit from global economic growth. In conclusion, investing with common sense bases on applying solid and proven principles, keeping costs low, diversifying the portfolio, investing consistently over the long term, taking advantage of compound interest, and controlling emotions. Index funds provide an effective tool to fulfill these principles, offering consistent returns and reducing unnecessary risks. The combination of discipline, a simple strategy, and a long-term focus allows investors to build wealth steadily, facing market volatility and uncertainties with confidence and efficiency. Adopting this approach allows any investor to achieve financial goals, minimize risks, and maximize returns intelligently. The key is not to predict the future, but to apply basic investment principles consistently, trusting that discipline, diversification, and patience will produce positive results over time. Investing with common sense is not just a strategy, but a path to financial security and sustained growth of wealth.